As we mentioned, at 8:30 Eastern time, we're going to be getting a read on the inflation at the producer level. Tomorrow morning, we get the consumer level with CPI data. Joining us right now with her take on the economy is Lindsey Piegza. She is chief economist at Stifel. And Lindsey, it seems like things are really kind of heating up for the Fed. You're at this weird inflection point. We know that the jobs picture is even worse than we had expected with those revisions that came yesterday. You saw what the Treasury Secretary, the additional pressure he's kind of putting on them. But we still have the other side of the mandate. That's the inflation numbers. What do you expect today? What do you expect tomorrow? And then what does the Fed do with all of that?
Well, we are looking for a relatively benign inflation report, up a couple tenths of a percentage point. So not much movement on the headline. But still, when we look at this nominally, price pressures are elevated above that 2% target, as they have been for years. And that's where the Fed's focus has really been for the past several years. But now, as you mentioned, with the labor market data showing this cooling in terms of momentum, the Fed is shifting their focus back to that other side of the mandate, full employment. And I think with that benign inflation report, coupled with the loss of momentum that we've seen in the recent data, that is going to be enough to justify at least a near-term reduction in rates. But longer term, that still elevated level of inflation is going to put a floor in any further potential adjustments to policy.
All the stock market averages hit highs yesterday.
They're looking for an adjustment towards easy policy, easier policy.
I know, but it's like you don't know what to believe. It's sad. Last year, no one made any money. No one got any. Now that we know it's all said and done, wages barely, and not for all demos either, barely outpaced inflation last year, and now we know.
But still positive. It is adding support to the consumer, barely.
$1,000 for everyone was not statistically significant.
So you have wage growth, which is organic. You have some savings. You have positive earnings interest with higher interest rates. You also have consumers still relying on buy now, pay later, which yes is an inorganic support, but after that deleveraging post-COVID, there's still a lot of room to grow the liability side of the consumer balance sheet. So I think there's still a good amount of borrowing and spending
power out there
for the consumer.
Is it restrictive right now?
Absolutely.
Then why are the financial markets doing what they're doing?
Because they're looking for the Fed to move towards neutral or further into neutral, depending on.
So Jamie Dimon said yesterday that we're definitely in a slowdown. You're looking at a slowdown based on what he sees, based on where the economy is, but you still have all these companies that are making lots and lots of money in earnings. And maybe that's where you get this dichotomy between what the stock market's reflecting and the concerns you hear on Main Street.
It could be. I think it's very true to say that we're losing momentum. We're slowing in some aspects of the economy. But to say that that's synonymous with an outright downturn.
No, and he said it's a question as to whether we get to a recession or not. Things are slowing down. We'll see if that continues. We'll see if there's something else that happens. But then you've got numbers like you saw with Oracle last night and the expected continued demand for cloud services when it comes to AI. I mean, those are the things that are hard to kind of put together. When you look back, what does this compare to? What economy?
Well, I think it's difficult to find a comparison. But I think the biggest risk when we look at the dichotomy, as you say, in the data, it's not the risk of a downturn or outright negative territory, as we saw in the first quarter. I think the biggest risk is a stagflationary scenario, because this is a Fed that is very willing to tolerate above target inflation, which will eventually choke off upside potential growth, leading us to, again, not necessarily recessionary conditions, but a stagnant economy, coupled with still elevated price pressures, the very definition of stagflation. And that's the most difficult scenario for the Fed, because they're going to want to raise rates in response to elevated inflation, but the economy is already at near zero levels. Vice versa, they're going to want to cut rates to stimulate the economy, but they don't have that upside option because of the elevated level of inflation.
So the number at 8:30, the PPI, what should we be looking for? You said a couple percent higher. What would be a red flag, if anything?
I think the big red flag would be a significant rise on the top number, the headline, precluding maybe the ability for the Fed to cut rates next week.
You think it's possible that there's a print that could take place today that would make the Fed go on hold, because then the market would be in for a real shock?
I think if we saw a significant rise in the PPI, coupled with a significant rise in the CPI, I think that would give the Fed maybe a pause before they made a move in September. But again, that's not our base case scenario. We're looking for a very benign inflation report, just a couple of tenths of a percentage point movement, not much movement on the headline. leaving the Fed's expectations for that 25 basis point rate cut next
We've
year.
been talking about the asymmetric risk was much more on the downside for a long time in terms of inflation. Now we know that last year we got half as many, over the last 12 months, half as many jobs as we thought, 75,000 a month. And in lodging and some of the places where you would think that if it was a good economy that they'd be doing it. When does that show up in inflationary expectations? When people really can't ask for more money, can't switch jobs right
well,
now?
remember, the payroll number is not the only data point that we use to judge the labor market. And I think it's fair to say that the labor market data at this point are not all pointing in the same direction. Remember, the unemployment rate is still very low, down near 4%. Initial jobless claims are still very range-bound
It's
low.
because of the participation rate. We'd be at 5% if the participation rate was
the participation rate did tick up last month, minimally, but it did tick up.
But it's way below. Is there any way that we're not really taking into account the slowing demand in terms of inflation right now? Could this be a cool number, much cooler, or it's we've thought about tariffs so much?
Number, but remember, consumption has been holding up relatively steady. We look at the retail sales numbers; they've been pretty steady at about 4%.
Though, right? Not on the low end.
Well, there is this, of course, there's the dichotomy between those at the lower end and those at the higher end experiencing that massive run-up in net worth over the past couple of years. But we're still seeing positive retail sales. We're still seeing overall, on average, 2% consumption numbers. So, yes, this is indicative of a slower economy, but by no means an economy that's in need of ample support from a Federal Reserve when we're facing still well above target inflation.
Will they do 50? And if they do, what's that say?
I think they've learned their lesson from that outsized increase that we saw last year, that 50 basis point move.
So they don't move in 50?
I don't think there's an option for a 50 basis point move. That being said, we may see a dissent or two in favor of a larger 50 basis point cut.
And do you think we see 3 cuts this year?
I think 3 cuts might be overly aggressive. I think given the level of inflation and the lack of downside improvement that we've seen, I think that is going to limit the Fed's ability to cut rates beyond 2 at the most.
2 at the most. Okay.
So
2 at the most.
You think they'd skip the November meeting? Or
I do. I think if we saw the 2 rate cuts, we'd see 1 in September and at the earliest December.
But
remember, the upside risk remains. If we see the inflationary pressures accelerate because of a more positive growth profile, or because consumers ramp up in that key holiday spending season, or because businesses start to pass on more of this tariff-related cost or other costs to consumers, that's going to severely retard or entirely eliminate the Fed's ability to push through even a second-round rate cut. So it's going to all depend on that balance between the employment and the inflation data.
It's hard to root, hard to root for a lousy economy so that you can get another rate cut.
Exactly.
Right. But isn't that what this market is doing?
I think
there's no other way to
doing it, but I think we're going to get it. I think
You think we're going to get a lousy?
I think it's lousy right now.
You think it's lousy?